welcome to the War Hunt quarterly market update for 30 June 2022. Now, Steve, it's certainly been a very volatile time in the last 12 months, and particularly probably the last quarter. The key themes, or key three themes, being inflation, inflation, inflation. We've seen that early on in the bond markets having an impact, and probably more recently with equity markets, both domestically and globally. So with that sort of background or context, Steve, how have the markets performed in Australia?
Yeah, let's look at Australia first, Sam, and you're absolutely right. If you look at the quarter by quarter returns, you can see that it was fairly benign in the last half of last year. And Australia, even in the first quarter where you start to see that volatility increase, Australia still managed a small positive return in the first quarter, really defying gravity because every other market was negative in the first quarter. But in the second quarter, we've caught up to the rest of the world, and you can see that the ASX 300 is down by 12.2% for the quarter.
So, Steve, what's happened in other markets?
Yeah, well, it's much the same story, Sam. Now, to be honest, they've been falling since the first quarter, but you can see here that the world market, basically developed markets, that's down by 8.4%, and the emerging markets are also down only 3.3% in the quarter. But don't get too surprised by that because they're down by 18% over the year.
So, Steve, clearly inflation is a theme that's panning out worldwide and in Australia. How's that impacted on fixed interest markets?
Yes, well, as the audience will know, fixed interest markets were really the first to get hit with news of inflation. So again, when you go back quarter by quarter, the last bit of last year, returns were close to zero in the bond market, I think, as everyone knows. But then with the first hint of inflation, yield started to rise, and that's the line you can see in that chart, yields rising. And of course, what's happened, Sam, is that inflation is much higher than initially expected, not helped by Russia invading Ukraine, which has pushed up inflation even further. One thing about that line chart, though, Sam, you can see that it's sort of turned a corner in the last few weeks, and in fact, bond returns have been positive in the last month. And the reason for that, as many commentators would say, is that bond markets have now fully worn the pain, that they don't see cash rates, which are priced into those yield curves, going any higher than they are. And so bonds are now performing their historical role of actually being a buffer against the falling equity markets.
So, Steve, it's probably the first time in a long time that we've seen a negative return in bonds, and typically would track that to the end of a calendar year. But going back, the last period, I think in memory, was 1994. We had a negative return in both equity and bonds. So this is quite an unusual period that we're seeing.
It's a very unusual period, Sam, but as you've correctly said, it's not the first time we've seen both bonds and equities down. And an interesting point about 1994 too, in 1995, both bonds and equities had extremely strong returns. I think bonds were up by 18% in 95. Now, we don't know what the future holds here, but having a down market is not unheard of.
No. With that background, Steve, in both domestic and international markets, I'll just touch on briefly the War Hunt investment philosophy. We've got sort of three key focuses. One is that we tilt clients' portfolios towards equity markets because equity markets should provide a higher return over the long term than fixed interest markets. We also tilt our clients' portfolios to the small premium and to the value premium. So with those three factors in mind, Steve, how's that planned out for markets both domestically and globally?
Yeah, Sam, well, out of those three factors, of course, the equity factor we know at this point is negative, as everyone knows. And when you look at the chart here, you can see that small companies, both in Australia and globally, are underperforming their large market. Now, that's not surprising. In down markets, small caps tend to get hurt the most. But when you look at the value, while the Australian value is negative, it's not as negative as the overall market. So there's a very strong positive value premium there. And you look at global value, Sam, and in fact, it's the only arrow pointing up. So of all the asset classes, it's global value stocks that have had a positive return. So it's this huge value premium in markets, which has really helped the War Hunt portfolios, really push them above their benchmarks.
So what are some of the factors behind that strength within value?
So value has not been doing that well over the last few years because The big tech stocks, which are growth companies, have done so well. I'm sure, as everyone's heard, the Apple, Netflix, Google have really had an amazing run. Well, guess what? They're the ones that have fallen the most. So when you look at the chart here, the S&P 500, the American market, well, that was down by as much as 20% over the half year, Sam, and that's what they call a bear market. But the NASDAQ, and I'm really representing this by the fangs, that's been down by as much as 30% in year-to-date returns. So that really is a huge fall. So yes, they had a great run, but they've got the biggest fall because the big growth stocks are down so much. It's the value stocks that have come up, and that's driving that value premium.
Yeah, which really speaks well to that focus within our portfolios of having them tilted towards that value premium. So Steve, it's certainly been a very volatile period in the last 12 months. In fact, the last 3 years, to be honest, with COVID and the invasion of Ukraine and now inflation on the agenda. Certainly, we're not trying to forecast what's going to happen in the future, but what do this type of volatility generally mean for portfolios or equity returns?
We do have some information what happens around market downturn, Sam, and it turns out that markets recover remarkably quickly. So you can see in the chart here that after a market downturn of 10%, then markets fully recovered by 1 year. And for a market downturn of 20%, markets fully recovered after 1 year, and quite extraordinary returns after 5 years. And even a market downturn of 30%, then after 5 years, you see these very strong returns. So what you take out of this, Sam, is that it's not unusual to have market downturns. They do happen from time to time. They're unpleasant when you're in it, but markets tend to recover typically within a year from a market downturn.
So Steve, it probably speaks to that old adage about all successful investing is very much goal-focused and planning-driven, and all failed investing is very much market-driven and reactionary. So whilst we can't forecast these periods of negative returns, we fully anticipate they will happen from time to time, but now is not necessarily a time to make changes to a portfolio unless there's been changes to your personal circumstances.
That's right, Sam. We'll just finish off with this last chart showing long-term investing and sort of marking it along the way with lots of events that have happened, both geopolitical and other events like COVID. And it's not unusual to get these market downturns, but the markets recover, and the best thing you can do is stay disciplined, stay in the portfolio that's been set for you by your advisor, and you will earn those long-term returns.
Thank you for attending the War Hunt's quarterly market update for 30 June 2022.